All right, let's get right into it. Edison International just dropped its third quarter earnings for 2025, and, on the surface, it looked like a home run. But the way the market reacted, well, that told a completely different story. So in this breakdown, we're going to unpack the numbers, dig into management's new de-risking narrative, and figure out what it all means for the stock from here on out.
So here's the plan. We'll kick things off with the scorecard, the headline numbers. Then we'll get into that de-risking story management is pushing. After that, we'll look at how the market actually voted with its money and what catalysts are on the horizon before we wrap it all up with our own forward-looking analysis in the next call.
Okay, so first things first, right? The big question. Did Edison beat or miss? The answer is a pretty decisive beat. Yeah, on both the top and the bottom lines. Let's take a look at the actual numbers.
Starting with core earnings per share, which is really the number the analysts obsess over. Edison came in hot with a beat of over 8%. I mean, that is a really strong way to start.
And it didn't stop there. Over on the revenue side, another solid beat. The company pulled in more than 2.5% over what Wall Street was projecting. So you're seeing some pretty healthy performance up top. Here are the specifics for you. Edison reported core EPS of $2.34 when the consensus was sitting at $2.16. But, and this is important, there's a key detail hiding behind that big beat. A GRC true-up, which is just a fancy term for a retroactive rate adjustment, added about 55 cents to that number. So, if you strip out that one-time boost, they actually would have missed.
All right, moving on from the numbers. Management spent pretty much the entire earnings call trying to paint a very specific picture for investors. The theme? De-risking. They want the market to see the company as safer, more stable, and more predictable than it's ever been.
And they're building this whole de-risking story on three main pillars. First up, big legislative wins like Senate Bill 254, which helps them handle wildfire liability. Second, they're finally settling some of those old, lingering wildfire claims. And third, they're showing real, tangible progress on hardening the grid, with thousands of miles of covered conductor already in the ground.
And you don't have to take my word for it. CEO Pedro Pizarro really hammered this point home, calling the new law a constructive and important step. This quote tells you everything you need to know about how central this political victory is to their whole pitch. They're essentially telling Wall Street, hey, the regulatory world in California, it's getting better for us.
So how does this de-risking story actually translate into dollars and cents? Well, because of all this progress, management felt confident enough to narrow their full-year guidance upwards and reaffirm their long-term growth rate of 5 to 7%. They also laid out a massive capital plan. And, this is the really key part, they said they can fund the whole thing without issuing new stock. For investors, that's huge because it means they won't be diluting your shares.
So, let's recap. We've got a strong beat, a really confident long-term outlook, and this clear story about de-risking the company. You'd think the stock would pop, right? Well, that's not exactly what happened.
And this is where we see this fundamental disconnect. On one hand, you have management broadcasting this message of stability, of clear skies ahead. But on the other hand, the market's immediate gut reaction was to hit the sell button, and on higher than average volume too. The day after the call, the stock closed down over 1%. Now look, it's not a massive plunge, but it's the direction that matters. It's a clear signal of skepticism from investors. And this really brings us to the million-dollar question for this whole explainer. With a clean beat on paper and such a confident message from the C-suite, why did investors head for the exits? It seems like the market is basically saying, we hear your story, but we're not quite ready to buy it. Not yet.
So what's it going to take to get them convinced? Well, the market isn't really focused on this last quarter anymore. Its eyes are now affixed on a very specific roadmap of future events and potential hurdles.
This timeline really shows you what's coming up. In the very near term, all eyes are on the regulator's decision about the Woolsey Fire settlement. Then in November, you can bet that every word from management at the big EEI financial conference is going to be scrutinized. Looking further out in 2026, the market is waiting for cash from securitization, that's just a way to borrow against future revenue, and a critical Phase 2 report on wildfire policy. This is the checklist that's going to drive the stock. Which brings us to our final segment, the next call. This is our forward-looking verdict, where we take all of this information and boil it down into a clear rating and outlook. Okay, let's put it all together. For next quarter's results, we expect them to land right in line with their new, narrower guidance.
For the stock itself, we think it's going to be stuck in a range. The market really needs to see some of those catalysts on the timeline play out before it's willing to push the shares higher. The key risk? It's still that wildfire overhang and just plain old execution. So, for our overall rating, we're calling it a market perform. The de-risking story has been told, and at this point, it's pretty much priced in. The market is officially in show-me mode.
And finally, before we leave you with one last thought to chew on, here's the required disclaimer.
Just a reminder, this analysis is for informational purposes only. It is not financial advice. And we'll leave you with this question to think about. Management has done a great job of shifting the narrative away from past disasters. But now, they face a totally different kind of challenge. Is the real risk for Edison no longer about the dramatic, splashy headlines of wildfires, but about the quiet, day-in, day-out execution of a massive, multi-billion-dollar plan? Because that is what the market is going to be watching.